What's going on, everybody? James Livingston here, back again giving you guys another trading related video. Today's video is pretty special. I did go into our Discord, the Alpha Stocks Lab. If you're not a part of a great community, click that link in the description. Get a part of one ASAP today. Excuse me. And I did ask, for you guys to ask me questions so I can do a little Q&A session for you. As far as anything really trading related, now I will preface, there are some questions in here that I will be making full videos for, going over certain things, because a lot of them are questions that I feel like need a better explanation. I don't want to create like a 40-minute video here, kind of just going over, exactly in depth for all that. I'd like to do some dedicated videos to certain topics here, and I'll let you know that, as we go through the questions. But first and foremost, the first question that I got asked was, what are your dividend stocks you have or looking into? I'm not gonna lie, guys, I don't personally have any dividend stocks as of right now. I will say I did do just a quick little research, Google search on ones that are a little more beneficial. These days, and pretty tried and true ones. It seems like a lot of the stuff revolves around, like oil, any kind of oil stocks, XOM, Exxon, CVX, that's CVX as an X-ray, for Chevron, as well as, some household names, Pepsi, PEP, Coca-Cola is another good one, KO, Johnson & Johnson, J&J. So there's a lot of good dividend stocks. I am not the one to give dividend advice by any means, so I'm not going to act like I know tons about dividend stocks. But those, just from a quick Google search, and that was as of December, that those were the kind of top stocks. So it seems like they're still pretty hot. I know a while back I actually looked into some of the dividend stocks myself, just to kind of get a grasp of the whole dividend stratosphere, and a lot of these names were actually there back then, so they seem to be continually, long-term, mid to long-term, kind of holding up pretty well. So yeah, those would be my picks personally for the dividend stocks. Next question here, what time frames is the RSI the most useful? I will go over a full video, like I was saying, on certain topics here, a full video for the RSI, as well as I know there's questions in here about the MACD. I'll go into a full video kind of going over the benefits of using those, how you can use those, etc. But I'll just kind of keep it very simple for you. The time frames that I find best for the RSI are larger time frames. I feel like you get a lot of fake outs on the lower time frames, the 1 minute, the 5 minute, the 15 minute, lower time frames like that, even sometimes a 30-minute. So I tend to focus more so using those to my advantage, along with my strategy on the larger time frames. So weekly, daily, 4 hour, 1 hour, those kinds of frames right there, I feel like are best for it. So I would say that about the RSI. Do you use open interest at all when deciding a strike price? So this is in regards to when you're picking like options and stuff. Yes, open interest is definitely very important to me, because I want to pick stocks. I want to pick, I want to pick options, contracts that have good open interest. So I know that if I get into them, there will be a buyer on the other side when I'm ready to get out. Sometimes people will get into these options on like penny stocks, for example, where they'll have not much open interest on certain contracts. Like even here on Google, you can see some of these in the money contracts with only 460 open interest. I personally wouldn't go for these ones, mostly because they do tend to have a larger spread for the bid to the ask, and you want to find ones that have a tighter spread, because number one, like I said, you want to be able to get in and out of those contracts. So if you get into it, you want to know that you can just sell it, really whenever. You don't have to necessarily be waiting around for a buyer for your contract. The other reason is when you have higher open interest, they tend to have a tighter spread. So if you do market buys like I do, you won't have to worry about getting filled, I don't know, $20 more than what you wanted to, because at the end of the day, the market's going to give you the best available price at that moment. If the best available price at that moment is closer to the ask, you're going to get it filled in higher, and when you get in your position, you're going to instantly be down $20, whatever it is per contract. So you want to take that into consideration when looking at contracts And just in general, when you're buying contracts, not only for the open interest, but make sure you look at the spread, the bid to the ask, and make sure that there's not a huge spread there. If there is, maybe consider doing a limit buy instead of a market buy. That way you can kind of get in where you want to. The risks of doing that obviously are that you might not get filled. You might miss the play because you never get filled on that limit buy, but I would much rather miss a play than get filled in much higher on a play and then end up going against me. So not only did you get whacked right out the gate, but then you got, you know, destroyed on the play itself. So yeah, open interest is definitely important to me. I recommend usually at least 1,000 plus with open interest. There are certain times where I will go down. You know, if I know there's like pending news on something, I'll go maybe as low as like 700 to 800. But again, on those types of plays, I will most likely do a limit buy and wait for my fill. If I get a fill, great. If I don't, I don't. It is what it is. So yeah, open interest is definitely very important. What to look for if there may be a continuation into next trading day, whether into pre-market or open, and why. So it's a very interesting question. You know, obviously at the end of the day, myself, you know, some of the best traders out there, we don't necessarily know what's going to happen, but we have to use context clues to kind of decide that. Let's just take Google for an example here. Whenever you see the things that I look for personally for continuation, I want to see strong candles, whether that be for sell side or for buy side. So strong candles can be, you know, something like this. You can see this daily candle about 8 days ago or so. Excuse me. Market had a very strong sell-off. Sellers pretty much pushed it down most of the day. Very small wicks on either side. The downside had a little bit of a bounce by the buyers there. But overall, you know, just a very bearish day. You can usually tell just by looking at the candle and how large it is, the body itself. You know, we don't want to see wicks, so we don't want to see crazy amounts of wicks. You know, a little wick like this, not too big of a deal, but we don't want to see wicks like this. You know, this was a clear sign that in this uptrend right here, as soon as we saw those wicks, those rejections, and we formed that kind of shooting star almost pattern or shooting star candlestick right here, kind of had the whereabouts of the inklings that, you know, there's a good chance that this will fall or the trend is coming to an end as far as the upside momentarily. It doesn't mean the overall trend is coming to an end fully. As you can see with Google, it did this, you know, 3 times in the last, I don't know, 2 months or so. So you know, it just gives you context clues. Like I said, for strength candles, for movement to the upside, I like to see solid green candles. If you see a solid green candle, especially after a smaller candle before that, it's definitely showing you that buyers are gaining strength. Maybe you can see here a little bit of a pullback, but within 2 days, we were right back up and making new highs. So depending on your trading style, you could use this to your advantage when it comes to swing trading. The same candlestick identification for me goes hand in hand on the smaller time frames as well, in terms of the, I would say as low as like the 30-minute, maybe the 15. I don't use anything less than that. I don't hold to a you know, like this is definitely going to go up. Like I want to see full strength candles or reversal candles on the 15, 30-minute and up. Those, you know, the larger the time frame for me, the more confluence I have that the buyers or sellers are really gaining traction. I don't want to see a 5-minute shooter, a 5-minute shooting star like we see here, and kind of decide that, okay, now we're switching to a full-on downtrend, because it's just too small of a time frame, it's too small of a sample size essentially to say we're going to go down. You know, I'd like to see it on those larger time frames where we have larger accumulation of the sells or of the buys. So hopefully that answers your question, but that's kind of how I identify what direction the market might want to go in. Obviously, using your EMAs in, I don't know what the word I'm looking for is, in confluence with them. So, you know, if we're in a downtrend already, underneath of the 20 EMA on those 15 to 30-minute time frames, and then we start shooting, putting in a shooter or shooting star style pattern, or a bearish engulfing candle, you know, reversal candles like that in a downtrend. You know, that's pretty high conviction for me that the trend wants to continue to the downside. So yeah, that's kind of how to look at the continuation, whether it's into the next day, whether it's intraday. That's how I view it. How can you tell if it's going to be a short trend or long trend? With this question, I'm not really sure if you mean like short as in like selling, or long as in buying, or if you mean like how the length of time for a certain trend, whether it be an upside or downside trend. I'm going to answer it as if it is the latter that I just said, in terms of like how long a certain trend is going to last. That really, again, just like we kind of explained with the time frame thing and how to understand the continuation. It comes down to what time frame you're looking at it on. If you're on the 15 to 30 minute time frame and you see a certain trend, I only anticipate that trend could last intraday, aka maybe a few hours, maybe an hour or two. It really comes down to whatever time frame you're kind of viewing it on. Like you can see on the larger time frame for like Google, we were rocking in a daily or in an uptrend. Even though we have these moments of pull down, we always kind of set in those higher highs, higher lows. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, and now we're starting to set in a new a lower low right now. So it doesn't necessarily mean we're going to fully switch this to a downtrend, but we're definitely getting some indicators here, being under the 20 EMA, being under the 60 EMA even, and this is on the daily time frame. So larger time frame, we're starting to see the trend start to shift. You can see we clearly broke a trend line right here. Now what I would expect to happen is we would most likely retrace to that trend line and see if the sellers can kind of put in a shooting star candle or some kind of a reversal candle at this area to signal that maybe it wants to go back down and now start a potential downtrend. So there's certain ways to look at these things, but it depends on the time frame you're viewing at that moment for as far as if it's going to be a short-term trend or a long-term trend. We go through your thought process on deciding which strike price and expiration date to choose when executing a trade. Yes, I mean, it's pretty simple. I notice a lot of people overcomplicate this, and I did myself in the beginning, so I'm not saying that you guys are dumb by any means. It's just kind of the learning curve. But when it comes to deciding your strike price and expiration, it depends on what type of trade you're looking to take. Like, are you looking to take a scalp, like a very quick in and out? You're only going to be within I don't know, 1 to 15 minutes, something short like that. If that's the case, there's no real reason to be buying out the expiration, buying out 2, 3, 4 weeks out. You don't really need to do that, but you also need to respect that you are doing it on the short term in terms of, like we just said, you're only looking to be in it for 1 to 15 minutes, so don't hold it past that time. If it doesn't hit your target in that amount of time, cut it wherever it's at, reevaluate. You can always get back in. Like, there's people get so afraid of FOMO, fear of missing out, but I'd much rather miss out than stay in something way too long to the point where, one, the contract's going to start decaying. The Greeks they're not on your side, they're against you. And two, I'd rather miss out on a play instead of breaking a rule, because in the long run, a lot of you guys need to understand that you need to have a set of rules, because if you try to just free ball it every day, eventually it's going to catch up with you. You might go on a lucky winning streak for a little bit, but eventually it's going to catch up with you, especially if you're continuously breaking rules, sizing in too much. If you're way down, averaging down too much, eventually it's going to come back and haunt you. So depending on the kind of trade you're doing, you need to respect that time frame and respect those rules. So when it comes to scalping, I typically recommend for any given stock, I would say, let's just X ETFs, because ETFs have 0 DTEs and 1 DTEs. We'll get into that in a second. But like Tesla, Nvidia, AMD, Meta, Netflix, all these kinds of stocks, if you're looking to trade it that day and you're expecting to be in and out of the trade, between the minute you get into it to, like, I don't know, we'll say 30 minutes later, weekly contracts are fine. as long as you respect that rule that you are going to get out. If it passes your 30 minutes, evaluate. If it feels like it's not really doing what you want, get out. Get to the next one. Don't waste your time sitting there. It's going to mentally debilitate you, and you're going to find that it's much more destructive to stay in the trade than it is if you just cut it, lift that weight off your shoulders, move on to the next one. If it's a trade that you're looking to potentially stay in for hours, even if it's just an intraday day trade, I would get at least a week, possibly 2 weeks out. Just because, again, that time decay is what really is the deciding factor here. You want to offset the time decay. So buy 1 week to 2 week out. I mean like the next week. When I say 1 week, I mean the following week or 2 weeks from the week that you're on. That way you can kind of buy time. That will allow you to hold it through a day, decide towards the end of the day or when a move starts happening if you want to hold or if you want to get rid of it. And even in some cases, you could possibly hold it overnight and be okay with theta, as long as obviously it goes in your direction. If it goes against you, it's the risk you run, and that's where you have to evaluate based on the chart, based on the technicals. Do we look like we're in a continuation, for the next day, or do we look like we could potentially reverse? Are we seeing candles like this where it's just indecisive? There's no real buying pressure or selling pressure, just chop days. There's no real sense of direction, etc. Kind of gives you a little bit of time on those 1 to 2 week out contracts. And then finally, if you're looking to swing trade, aka hold it for multiple days, potentially 1 to 3 to 4 days, you might want to consider going with 1 month out all the way up to like 3 month out contracts. As far as strike, I always say go out of the money unless you are expecting some major news on a stock that you are almost for sure that it's going to go up or it's going to go in your direction, up or down. Then what I suggest is to get right at the money contracts and allow them to kind of just milk the delta part of the contract as it moves in your direction. So you can kind of be ahead of the game, and be able to hold those a little bit longer and kind of just ride it through. Because once you're in the money, the time decay significantly decreases and the delta goes up. So your profit to time decay significantly offsets once you go in the money. As long as you're out of the money, time decay is going to always be above. Or almost always going to be above or right close to it. So you're never really going to have breathing room. So that would be my recommendation when it comes to deciding which one you want to go with as far as a strike. I would say almost always it's out of the money. And when I say out of the money, I mean 1 to 5 spots. The further out of the money, the riskier, the less chance that you're going to make money because the delta is going to be significantly offset by the theta. And I'll make a whole video as far as reading the Greeks, how you can kind of figure out a play there. So we won't go too deep into it because we'll have an actual video, but I think that kind of answers your question as far as thought process, strike, and expiration. Is there a particular candle type that immediately signals a reversal in direction? And the other question, how do you use the MACD to determine buy and sell opportunities? Again, we'll go over MACD in the RSI video as well. I will just say with the MACD part of it, larger time frames are always best when it comes to these, in my opinion. The signal as far as for a buy or sell is typically when the MACD line either goes under the signal line, that's usually a sell signal, or if it goes up over the signal line, that's typically a buy signal. So hopefully that kind of helps you until the video comes out. But is there a particular candle type that immediately signals a reversal? It just comes down to these shooting star candles. We have a long upper wick. When you're in an uptrend, you get a candle with a long upper wick, smaller body to the downside, typically signals a reversal to the downside, whether it be the next day or in the next couple days, or if you're looking at an hourly candle, it could be in the next couple of hours, it could be this next hour, the next couple of hours, etc., depending on the time frame you're looking at. Same thing with the upside. You have these hammer style candles like this one right here, so you can see obviously the opposite of a shooter or a shooting star. The hammer has a long lower wick, small upper body. Essentially, the way that I look at these is like price went up here, sellers kicked in heavy, and they pushed it down. It's like they shoved their head in the dirt almost, pushed them down. This one right here, it's like, think of it like a trampoline. You know, they jumped down on it a bunch of times, and eventually they started jumping really heavy, and they rejected it back to the upside. It's the best analogy I can kind of give there. But you know, it's just buying pressure showing there with this wick, and selling pressure showing there with this wick. Then you also have engulfing candles. This would be an example of a bullish engulfing. So you have a clear downtrend right here, you know, 3-day downtrend, and then you get a solid bear or bullish engulfing. So it engulfed that prior day's candle with full-on bullish action. You have volume to support it as well. Signals to me that there's a good chance this will reverse back to the upside. Same thing with bearish. You know, in this case, we had the shooter, we pushed down. Buyers seemed like they got a little bit of traction right here, and then we had a bearish engulfing candle the next day, where that candle kind of engulfed the prior day. Sure enough, we went down, and then the next day we formed the hammer candle to bounce back up. So there's that then. When choosing option to buy, what time frame should we be looking at to make entries? I kind of went over that one in that last question. What are your thoughts on playing earnings? Complete and utter gamble every single time. It does not matter if the company beats, double beats, that thing can still drop like a rock. It's a complete and utter gamble. I don't recommend it unless you're going in with basically a lottery size, so you know whatever money you put into it, you're accepting the fact basically from the second you buy it that it will go to zero. And if it doesn't, awesome, you made money, whatever, cool. But basically earnings are 100% a gamble. Like I said, there's no real way to tell how the market's going to react unless some groundbreaking news gets reported. But again, you're not going to know that until the earnings gets put out. So most of the time, I don't recommend playing earnings unless you have a plan. You know, if I put this money into it, I'm going to lose it. You know, sometimes we'll do some lotto earnings and they'll make out really well, but we do a method of kind of like a straddle or strangle, however you want to say it. Buy a call, buy a put. One of them's going to lose, or both of them will lose. The way that both of them can lose is if the price just kind of stays still. Time decay is going to destroy those contracts. So yeah, earnings, I recommend don't play them and just wait until after the earnings to see how the reactions are and play that accordingly. How to spot a break, for example, when coach says to watch Tesla break 363.84 for calls, how do I confirm the break? So we do have another video in the Discord. So again, if you're in the Alpha Discord already, you'll know about this, but in our Alpha training section, you can actually find the video for how to execute the levels. It's not too far up, you just scroll up a little bit, but essentially when those levels are posted, they are posted in the morning, just like if I post levels in our Discord in the morning. They are meant to be acted on in the morning. They are not meant to be acted on in the afternoon. They are levels for that morning. So if the price action comes, let's just say it goes up to a level, it goes through it with that 1 minute candle, you want to see a second candle close above it. So a second 1 minute candle close above that level as well, and then you can execute the trade. Now, there are certain circumstances where that first level, or the first candle will break it, second candle will close above it, and it'll still drop right after. It's probabilities. At the end of the day, the market is just probabilities. We can't say for certain that this is 100% a method that's going to work all the time. There is no 100% win rate method, out there. So you can't rely on it strictly. You have to also study and understand candlestick behavior. You know, the identity of a candlestick, what does it mean when you see a candlestick like this followed by a candlestick like this? You know, obviously, if this candlestick right here, let's just say there's a 1 minute candles, if this one would have came back up, bought back up to like here, for example, so we had a long lower wick after a big, giant candle like that over a level, you could look into a buy position. It's showing that the buyers are still there. If you're uncomfortable with that second candle, what we recommend is wait for the third candle. If the third candle starts to push and starts to break that second candle's high, or even break that first candle's high, there's a pretty good chance that it's going to continue higher. So with those kinds of trades, again, it comes down to they are basically scalps, and what you use is your EMAs on the 1 minute time frame / 5 minute time frame, depending on how strong of a trend it is. Use your EMAs. As long as price action is above your EMA, if you're in a buy, hold the trade. If it drops below it, cut the trade. Very simple. Keep it robotic, keep it unemotional, and you will understand and see a huge uptick in your trading as far as your profitability, and you'll honestly just feel good for following the rules. So that would be my recommendation for that. Please explain the concept of lower lows, lower highs, higher lows. Pretty simple. It's just market structure. You're in an uptrend. If you are setting in higher highs, setting in higher lows, you are in an uptrend. If you are setting in lower highs and lower lows, you are in a downtrend. It's just market structure. It just helps you to identify what kind of a trend are we in, which side has more of the probability. If I'm looking at calls, are we in an uptrend? If we're in an uptrend, you can ride those calls a little bit longer. You can have a little more conviction with that play to the upside because you're in an uptrend overall, or on the time frames you're looking at. You know, if you try to go for calls while you're in a downtrend, you need to be wary of that. You need to understand that you are trying to trade against the trend. Your trades should be quick. You should be in and out of those quicker than if it was if the trend was in your direction, because the probabilities are against you. You know, it is obviously in that scenario, it's obviously in a downtrend, but you're trying to buy and bet on it going up. Chances are you're going to lose. Last couple questions here. What plays are you looking at for this week? What makes you interested in we're not going to answer that right now. It's that's for the Discord only. How can you find supply and demand zones? Also, can you do a supply demand zone versus support resistance levels? Yes, I'll make a video on that one for you guys separately. That's a long topic. Don't want to get you guys all caught up in that in this video. And how do you calculate / decide your take profit zone apart from following the candlestick pattern? This depends on, again, when you get to certain supply, demand zones, support, resistance. Hey, buddy. Here, let me finish this real quick, okay? So this depends on, you know, the kind of areas that you're getting sellers to hop in. If you're in a buy, you know, you can see the different peaks in the chart. When you see those peaks, those areas generally are your take profit zones. If you're in calls, same thing for the downside. If price is coming down to a certain area multiple times and you're seeing those constant reactions to it, you're setting your take profits at those levels, you know, on a downward trend, or when you're in puts / shorting. So we'll kind of go over that as well in future video as far as how to set your take profit zones. I'll try and create a scenario for you guys, but again, I don't want to make this video too long because we're already coming up on 30 minutes. So, but yeah, guys, that's pretty much it. That was pretty much all the questions you guys had asked. A lot of great questions, honestly, and a lot of good future videos here to make. I'll try and get through those one by one here in the next week and a half or so. So stay on the lookout. But nonetheless, guys, I appreciate everyone who participated in sending out some questions. Hopefully, some of this video helped you guys out, showing a little bit of examples, just kind of talking to you guys, talking you through it. If it did, please, you know, leave a like, comment down below, let me know what you guys think. Let me know if there's any other video topics you want me to do in the trading space. I could definitely take note of that and, you know, put maybe some use to those as well. But and of course, if you're new to the channel, please hit the subscribe button. It means a lot. Definitely helps me out when it comes to you know, creating these videos, knowing that there's actually people watching. It's actually people being helped. That's the goal here. You know, I just want to help people out. You know, help you guys understand the market. So nonetheless, guys, appreciate you guys, and I will see you in the next video. Peace.